what we're going to be going over here is solving cost, volume, profit problems here in terms of dollar amounts here. So we're going to be solving for some targeted net income here before taxes and net income here after taxes in terms of dollars. Normally when we're working with these cost, volume, profit problems, we're looking at solving them in terms of a quantity or a number of units here. But in our case, we're going to be looking at it solving in terms of dollars here for some targeted income amount here. We're going to be going through looking at the general formulas that we'd be using here for our solving our cost, volume, profit problems here in terms of these dollars here. But before we get into that, let's go and let's look at the reference key that we're going to be using here. Okay, so for the equations that we're going to be going through here, I've got the different symbols here showing for and what they represent. So P here is going to be a unit sales price. That's on a per unit or per quantity here of 1. And then X would be the number of units. V would be the unit variable cost, again on a per unit of 1 here. And then I've got them color coded here just so you as a good reference here. So TFC would be the total fixed cost. TVC here would be the total variable cost. TR here, which equals S, our sales here, would be our total revenue or total sales here. And then TC would be the total cost, both the fixed and variable amounts. And then TCM here would be the total contribution margin. Then CMR here would be the contribution margin ratio. And then R here would be the rate of return here on sales. T would be this tax rate that we're looking at. And then net income here before taxes. And NIBT here is net income here before taxes. NIAT here equals the net income here after taxes. So we're going to be really concentrating on these two variables here, this contribution margin ratio, CMR here, and also this rate of return on sales, R here. Okay, so now let's go and let's look at how we'd set up our different formulas here. So first, looking at this cost, volume, profit, the basic concept that we'll be looking at here. This is where your total revenues equals your total cost plus whatever profit you're looking at. So for our formulas here, TR here, total revenue, and then our total cost is TC here, and we'll start out with that would be plus our net income here before taxes. There's going to be some targeted amount here for our net income here before taxes. So then our total revenue here would equal our total cost, which is our total fixed cost, plus our total variable cost here, again, plus our net income here before taxes. And then if we rearrange this equation, just bring the total variable cost over onto the other side of the equation here. So we would have our total revenues minus our total variable cost equals our total fixed cost plus our net income here before taxes. So we just rearrange the equation here. And then our total revenue less our total variable cost, that really equals our total contribution margin here. And then total contribution margin just would equal our total fixed cost here plus our net income here before taxes. Okay, so now for our calculations that we're going to do here to solve for these cost, volume, profit problems here in terms of dollars. So we'll take our general equation here. Total revenues is going to equal our total fixed cost plus our total variable cost plus some targeted net income here before taxes. What we came up with our basic concept here. Okay, so now this is the case here where we're going to, this total revenues is actually going to equal, well, that equals our sales dollars here. Total revenues would equal our total sales dollars. Okay, so this is where we're going to do some substitution in here into our general equation here. So TR, our sales dollars here, equals our total fixed cost plus our total variable cost. So this is where we're going to substitute in here for our total variable cost. So let's go and understand what we're looking at here. So this is the case here where our variable cost ratio, that's going to be on a per unit base here, the variable cost on a per unit basis divided by the unit price here on our unit price here, each on a unit basis. So that's our variable cost ratio. And we take that times our sales dollars equals our total variable cost. Again, sales dollars here times our variable cost ratio here, V divided by P equals our total variable cost. So now we can go and we can substitute this S times our quantity here of our sales dollars times our variable cost ratio here into our equation here. We're going to replace our TVC here by that amount here, that S times V divided by P here. That's our variable cost ratio here times our sales dollars. Then just add our net income before taxes. So now we can rearrange this equation. Just moves our this S times V divided by P, move it over to the other side of the equation. So now we come up with S minus our variable cost times our variable cost ratio here times our sales dollars. Minus S, move it over to the other side of the equation here. So that we've got that amount here on this side of the equation. Now it would equal our total fixed cost plus our net income here before taxes. Okay, so now we can factor out our S here, our sales dollars, from this side of the equation. So what we're going to come up with now by factoring out our S, 1 minus our variable cost ratio here, 1 minus V, variable cost on a per unit basis, divided by our price on a per unit basis. That amount times our sales dollars. We just factored out our S amount here. So that's going to equal our total fixed cost plus our net income here before taxes. So we can further define this 1 minus VP here, and we're going to call that our contribution, or a contribution margin ratio here. Okay, so that's what we're going to call it. And that, looking at it in these terms, a contribution margin ratio, again, equals 1 minus the variable cost, variable unit cost, a variable unit variable cost here divided by the purchase price here. That's our CMR here. That's where our contribution margin ratio here. Again, unit variable cost divided by the unit price here. And we subtract that here from unit of 1. We factored it out here. Okay, so now we'll just put that, represent this amount here, 1 minus our variable cost ratio here. We'll call that the contribution margin ratio here. So that amount here, contribution margin ratio times our sales dollars, equals our fixed cost plus our net income here before taxes. So first, we'll settle for looking at our targeted net income here before taxes, the sales amount. All we're going to do is divide our contribution margin ratio by both sides of the equation here. So that eliminates it on this side of the equation, and then you would just divide move it over and divide this side of the equation by it. Would be total fixed cost plus our net income here before taxes, again divided by our contribution margin ratio here. That amount here, that would be the sales dollars that we'd have to have here. Okay, so that solves for our sales dollars here based on our net income here before taxes here. Okay, based on that contribution margin ratio, which is this amount here. Okay, so now let's look at solving it here for net income here after taxes. So what we would do here for the net income here after taxes is just 1 minus the tax rate times the net income here before taxes. So that amount here equals our net income here after taxes. So we are solving for net income here before taxes, just divide both sides here by 1 minus t. So you're going to come up with the net income here before taxes is going to net income here after taxes divided by 1 minus our tax rate here. Okay, so now we can substitute this amount into our equation here to solve for our net income here after taxes. So sales dollars here based on a net income after taxes here would be, again, a total fixed cost plus that amount here, net income here after taxes divided by 1 minus the tax rate, and that total amount here divided by the contribution margin ratio here. Okay, so that's how we got down to solving for net income here after taxes. Now, and we've also solved for the net income here before taxes through the substitution up here and the substitution here. We solve for both of those amounts. Now we can go and let's further expand it in this case here. So now we can look at the revenue needed when the targeted net income here before taxes and net income after taxes is a % of the sales dollars. So this is the case here. We're going to define R, that's the rate of return here on sales. So all we're going to do here, R is going to equal our net income here before taxes divided by our sales dollars here. So what we can do here, now solving it for this rate of return here, all we're going to do is we're going to, this net income here before taxes, it's now represented here as that rate of return here as a % of sales times our sales dollars. So now we can solve it for what we were looking at here, rate of return here as a percentage of sales. So sales here equals our total fixed cost plus the rate of return here on sales times the sales amount. Again, just divided by the contribution margin ratio here. Okay, so we solved that in for our net income here before taxes based on our first amount here, based on what we did up here, and based on just looking at solving in terms of dollars here. But now we further expanded it here based on that percent of sales here, and a percent of sales here based on our rate of return here. Okay, so we can do the same thing here for our net income here after taxes. So again, our rate of return net income here after taxes divided by our sales amount here. All we're going to do is we're going to substitute this into this equation here, into our net income here after taxes. We're just going to define that as our rate of return here on sales times our sales dollars. And again, divided by 1 minus the tax rate. Just substitute this net income here after taxes for our rate of return here times our sales here. So we come up with the total fixed cost divided by this amount here, rate of return divided by 1 minus our tax rate. That total amount divided by our contribution margin ratio. Okay, so we solve it in 4 different ways here, looking at our net income here before taxes, just in terms of dollars here. And we've done that for net income after taxes. And then we did it here in terms of a percent of sales, just by making this substitution here. Okay, so that's how you would solve for your looking at cost, volume, profit in terms of sales dollars here. We went through the basic equations here. Okay, so now let's further just go over here and look at our CP, cost, volume, profit graph. Again, everything we were looking at here was based on a single unit here. I'm not going to go into all the, don't know just how to show it here, but we'll go through just the representative amounts that we're really looking at here. So what we would have done here, we have our number of units across our x-axis here, and then we have our dollar amounts up here. So what you would do here, just to understand the basics here, you have some fixed cost amount here, and then you build on that fixed cost that you have some variable cost amount, starts at your fixed cost and moves up at the rate here of variable cost times number of units here. And then you have your total revenues line here, and that's at increasing at the unit price times some quantity here. So what you're going to have here is your total revenue, which would be some unit price times the quantity. And then for your total cost here would be the total variable cost. So variable cost on a unit basis times some quantity. And then you add to it the total fixed cost here. So your total contribution margin is just the difference here between your total revenues, or in this case your total sales that we should really be looking at, versus your total variable cost here, total contribution margin here. Okay, that would be your contribution margin here, and we're solving in terms of dollars here at some break-even point, and that's simply where your total revenues line here intersects with your total cost line here, just in terms of the dollar amounts here. Okay, so if you can further go down here and look at our line here for net income here before taxes, that blue amount here sloping up here, so that's adjusted down here, but we're going to have some break-even quantity here, and we were looking at break-even dollars in terms of dollar amounts here, but I'm just showing that in terms of quantities here. So, and then we have that net income here after taxes was that green line here sloping up. So just looking at our net income here before taxes, that equals the minus the total fixed cost times, in this case, let's just look at that contribution margin ratio that we looked at, 1 minus our, that was 1 minus what? V over P, or variable cost over a price, unit price here, times sales dollars here. So that's how you'd solve for your net income here before taxes, shown as representative amount here on our CVP graph, and then a net income here after taxes, that would be the net income here is equal 1 minus our tax rate times the quantity here of that we had for our net income here before taxes, that quantity rate here, minus our fixed cost rate times contribution margin ratio times our sales dollars here, represented over here. And then again, remember that contribution margin ratio was just 1 minus the variable cost on a per unit basis divided by the price on a per unit basis. Okay, contribution margin ratio. And then where they intersect here for our net income here before taxes was on our dollar amounts here would be just a negative total fixed cost here, and then for net income after taxes, it would intersect here at 0 units. At units is 0 quantity here. 1 minus a tax rate times the negative total fixed cost here. So anyway, this is just going through our general graph here and understanding what we were talking about. And we were looking at some break-even points here in terms of dollars versus quantities. I'm showing them at quantities here, but somehow you'd have to go back and relate what we've done here in terms of dollars, and I attempted to do it down over here. Okay, so that'll summarize our discussion here for solving for cost volume profit problems in terms of dollar amounts rather than quantities here. And we did it in terms of setting our net income here before tax, looking at net income before taxes and net income here after taxes. Okay, so that'll summarize our discussion.